Jerome Powell's in deep shit, and the Fed is about to have to make a move. More on that in a second. I'm Ryan Stewman, the CEO of Closer Capital, where we help entrepreneurs like you get access to the capital they need in order to grow and scale their business. There's a lot of talk right now from President Trump. He's been really being a dog to Jerome Powell for the right reasons. He's figured out that Jerome Powell has a political conflict of interest when it comes to lowering the interest rates. And whether you like Trump or not doesn't matter to me. I'm here to give you the facts about what's going on politically and how that affects us economically as far as our consumer and business finance. So hear me out. In October of last year, September of last year, the Feds dropped the rates. And right before the election, trying to get Kamala into office, making things seem like inflation had gone down, even though it would still continue to rise. But it was political manipulation to make us feel good so that we could direct our votes. That's what President Trump is claiming, as well as Bill Pulte, who is Pulte Homes, one of the largest home builders in America, who's now working for free, much like President Trump, as Secretary of State. So I say all of that because they figured out that once they got inflation down, and by the way, inflation beat the projections by 1%. We are the lowest we've been in 6 years right now. I'm sorry, the lowest we've been in 4 years right now, and we've beat the projections by 1%, yet the Fed just had a meeting last month and said, no, we're not changing anything. We're gonna watch and see what happens because of, wait for it, tariffs, right? So anyway, the Fed paused and they said, we're not sure about inflation, but now the results come out a month later and we see that inflation's actually 1% better than we thought. I think it is at 2.4%, I believe was the number, but don't quote me on that. Now, having said that, Trump has come out and he said, Jerome Powell needs, this is quote unquote, Jerome Powell needs to lower the interest rate now by a lot. That was his exact words, okay? By a lot. So I'm gonna break down what that will mean and what by a lot could be. But I'm going to tell you about a sweet spot economically in America that the Fed knows about, but they don't want us to actually have an accumulation of wealth, which is why they're always raising taxes and the interest rate. So I could go down the rabbit hole, a tinfoil conspiracy on that for you with hours, but I'm going to break down the benefits of what could happen in this emergency meeting if they lower the interest rate. So right now, the Federal Reserve overnight market rate is 5.5%. Mortgages in America right now are 6.875 to 7.25% on a 30-year mortgage with 5% down, Fannie Mae insured mortgages for the most part, right? Depending on when you're watching this, it could change slightly, but they vary between 6.875 and 7.25% on a regular basis, right? So if the Feds were to cut the overnight market rate by 1%, which is what they control in, and by the way, that has nothing to do with mortgages or auto loans. What this is the charge of interest to the banks that the Federal Reserve charges them. So it works like this. I'm the Federal Reserve, let's call me the big bank, and I got little franchise banks that have to pay me to borrow money from me because I'm the only bank that really prints money. They're the banks that save and loan money, right? So what happens is at the end of the night, if Bank of America, which every bank does this, they leverage deposits 10 to 1. So if you deposit $100, they loan out $1,000 in lending. So if they didn't clear because of delinquencies, foreclosures, missed payments, or whatever, if they don't clear enough money to cover those loans overnight, they borrow money from the Fed to make their bank account reconciled and whole. Then they pay 5.5% interest on that over the course of a year, but they pay 5.5% interest on that. And what they do is while they're borrowing that money from the Fed at 5.5 interest rate, prime is typically 4 points on top of that in the commercial world. So you're talking about a 9.5% interest rate that the bank has to clear in order for them to make profit. Okay, and that's just the bare minimum. Usually banks are prime plus 1, prime plus 2, which is why you see SBA at 13 to 15% in their loans right now. And honestly, when you're taking out a 5-year business loan at 13%, especially if it's on real estate or something like that, it doesn't make sense because you can't get a cap rate from it, which has caused loans to get slower, rates to get higher. Same thing happens in the mortgage world. People, like, I have a house that I have a $400,000 mortgage on that because of the interest rate has a bigger payment than a different house I have a $800,000 or $700,000 loan on. It's significantly different because the $700,000 loan is like 2.875 and the $400,000 loan is like 7%, and the $400,000 loan costs me more than the loan that's almost twice the size. So interest rates matter. That's why we're seeing stagflation right now. So we got inflation's lower, but guess what? Our dollar's worth less. Between 2020 and now, the dollar's lost 25% of its value. It's the biggest change ever in 4 years. On top of that, I'm not good. Like, I had an offer the other day. A guy calls me. He says, because I'm a fan and because I like you, Mr. Stewman, I'll sell you my $2.5 million house for $2.1 million. He goes, that's what I owe on it. If you'll take it, I'll cancel my real estate agent and you can have it. And man, this was my fucking dream home. 2.5 acres, a pond in the backyard, right down the street from here. It was right in my price range and everything. I crunched the numbers. It's 3 times the damn payment for what I have on my house right now. It doesn't make financial sense. And this guy's discounting this hundreds of thousands of dollars, and it doesn't make financial sense for me to make the move. My wife comes to me the other day. She goes, you think about selling our house? I was like, man, we got such a low interest rate and a low payment on this thing, we'd be fools to move anywhere else. Right? Now, that's the mindset of most Americans at this interest rate, okay? So at 7% interest rate, that's what we're thinking on a mortgage, right? Well, if the Fed drops 1%, so they go from 5.5 on the overnight market rate to 4.5%, that's going to have a trickle-down effect, but not what you think it's going to be. It's going to be mortgage rates are probably going to go down by 50 to 75 basis points, which is a half to 3/4 of a point. So you're going to see interest rates somewhere in the 6.25 to 6.5, maybe 6.18, 6. You might see 6.1 in there, but most likely 6.25 is going to come into there. Credit card rates, they're going to drop by 25 basis points, 50 basis points. They're not going to change that much. Personal loans will drop by 75 basis points, 3/4 of a point. So if you're out there borrowing personal money, 12, 15%, you might see that come in at 11, 13%. Auto loans will drop by about 100 basis points. So if you have a 7%, which is on average right now, auto loan, you'll see auto loans come at 6, which will give us an uptick in a little bit in real estate. It'll give us an uptick in a little bit in cars, especially with Trump's one big beautiful bill giving us interest write-offs on American-made cars. We'll see some uptick in that, but that's not enough to move. And if you remember, I said Trump said he needs to do it immediately and buy a lot, right? So if Trump says that immediately and buy a lot, 1% is not really a lot now, is it? You think the real estate mogul that we have as a president that understands real estate finance, understands how economies work because he's played at $1 billion and now multi-trillion-dollar level for several years, a lot's not 1%. So let's look at the flip side of this. What if a lot happens to be 2%? Okay? So if interest rates are at 6.25% with a 1% reduction, if a lot happens to be 2%, now we're talking a 5.25 to 5% interest rate. Now that on a mortgage will spark a housing boom. That is the sweet spot, in my opinion, and I've said this on many videos on this channel, that 5.5% interest rate on a 30-year fixed mortgage is the sweet spot. It will ignite refi booms, because why wouldn't you want to drop 1.5 points from 7 to 5.5 if you've bought a home in the last 2 years at 7%? Now you're going to be able to save 1.5% on your interest, be able to refinance cars. It's going to drive more people like me. I might look at that house at $2.2 million and go, okay, at 5.5%, that makes enough sense financially for me to move into something that I see myself in more than where I'm at now, right? So logically, Americans will start making these decisions at, okay, cars are a little bit cheaper. Maybe I can refinance mine or go buy a new one and trade it in. Houses are a little bit cheaper. Maybe the house isn't cheaper, but the payments are cheaper. So that allows me to go out here and get more house for my money, find something that fits into my standards. And what we will see because of this is a significant real estate boom. The refis and the mortgages, the refis and the auto, sales and auto and home sales. Now, what happens there? Realtors make money. Car dealerships make money. Consumers make money when they sell their house. Consumers save money when they refinance their house. Consumers save money when they refinance their car note and their personal loans. And what happens when people save money? Well, in America, if you don't know, we have a negative savings rate of $10,000 per American. The average person is at least $10,000 in debt in this country. To put that in perspective, in China, they have a positive savings rate of $25,000. Okay, communist country has more money than the average American here. Okay, now why do I tell you that? Americans don't save money. right? It's not like, oh, hey, I'm saving $1,000 a month on my mortgage. It's like, hello, new BMW. That's how they roll here. Okay, so it's not oh, now all this money's floating around, they're just putting it in their pocket and their CDs and their savings accounts. No, that's how people start spending. People start spending in America. Real estate is American. We're dealing with exports and tariffs from other countries. Real estate is American. It always has been, it always will be. The dirt, the houses, all of that is here. And so we're gonna see a huge boom. And right now the problem is, we've seen a massive exodus, and this is just a side note for those of you that are entrepreneurs looking for opportunity. In the last 3 years, we've seen a mass exodus from insurance, mortgages, and real estate. I believe the number is like 70-something% of real estate agents haven't sold a house in the last 2 years, right? We saw over 100,000 people exit the mortgage business in the last 2 years. So, getting in now, getting educated now, positioning yourself, marketing yourself now to pick up flip homes, become a real estate agent, become a lender, and ride this next wave, it's gonna be nice. So you can position yourself for that. If you're in those industries, now's the time to get ahead of that and start educating your audience as well. I hope you got something from this video. Maybe a lot means 3. And if they dropped it by at least, I would be surprised to see them drop it by 1, but if they drop it by 2 or more, golden age is on. We'll find out soon. Make sure you share this with somebody who would like to learn this lesson and who's interested in what's going on politically and economically in our country, because I think this solves a lot of people's questions, and you can help them out by sharing it. If you want to get a loan with us, just go to closercap.com or click the link below. Apply. Someone on my team will reach out and we'll get you started and get you set up. Catch you on the next one.